All right, let's dive right into this explainer. We're going to demystify the absolute foundational mechanics of financial accounting. Whether you're running a massive global corporation or just a small local coffee shop, the backbone of your survival relies entirely on how well you track your numbers. So today, we're going to make that entire process crystal clear.
So, you know how businesses have to make sure literally not a single cent slips through the cracks? Well, today we are solving the ultimate business puzzle. We're tracking exactly how a single transaction flows through a financial system. It's a fascinating journey, honestly, taking absolute chaos and turning it into perfect, balanced order.
Here is a quick roadmap for the journey of a transaction. We're hitting 1, the accounting process, 2, double entry rules, 3, balancing the general ledger, and 4, preparing the trial balance.
Okay, section 1, the accounting process. The journey begins. Let's map out exactly where a business's money starts its journey.
You know, accounting doesn't just mean throwing numbers at a wall to see what sticks. It follows a very strict logical sequence. Step 1 is analyzing raw transactions. You've got to figure out what actually just happened. Step 2 is recording that event in the general journal. And then step 3, we move that info directly into the general ledger, specifically into what we call T accounts, which, are literally shaped like a T, and that gives us a super structured view of every single individual account. Now, before we go any further, everything really comes down to one golden rule. A equals OE plus L. That translates to assets equal owner's equity plus liabilities. Simply put, every single thing a business owns, its assets, is financed either by the owner's own money, the equity, or by borrowing money, the liabilities. If this equation ever gets out of whack, well, something went very wrong in the accounting process.
Section 2, double entry rules. Every action has a reaction. This is the secret sauce that keeps that equation perfectly balanced at all times. Double entry accounting is, well, exactly what it sounds like. It's like physics. Every action has a reaction. Everything gets split in two sides, the debit side firmly on the left and the credit side over on the right. Every single transaction you make is going to touch a debit side of one account and a credit side of another.
Think of this as the visual engine room. Notice how assets increase on the left, the debit side, but decrease on the right? Well, for liabilities and income, it's the exact opposite. They actually increase on the right side, the credit side. Remembering this little visual map is absolutely crucial. It's the key to unlocking the whole system.
So let's see how this plays out in the real world. Say you sell goods on credit for 5,000 Rand. Your trade receivables and assets, right, because someone owes you money, goes up. So we debit the left side by 5,000. At the exact same time, your sales, which is income, also goes up. So we credit the right side by 5,000. Boom. A single event creates a left side debit and a right side credit, keeping our entire equation in total harmony.
All right, section 3, balancing the general ledger, finding the truth. Let's figure out where our accounts actually stand once all the dust settles. To find the truth, we calculate the account balance. Honestly, closing off or balancing an account is just finding the difference between the two sides of our general ledger. It's the literal mathematical difference between the increases and decreases, the left and the right, the debits and the credits. Whichever side is heavier, that dictates the final balance. Let's run through trade receivables to see this in action. On the left, the debit side, say we open with 5,000 Rand, add 13,000 in new sales, so that's 18,000 total owed to us. But wait, on the right credit side, a customer paid 9,500 into the bank. So comparing the 18 grand debit against the 9.5 grand credit, we've got a gap. To equalize both sides, we calculate a carry-down balance of exactly 8,500 Rand. And there it is. That is our true updated balance. Section 4, preparing the trial balance, the ultimate proof. This is where we prove we didn't mess up.
Putting together a trail balance is actually this really satisfying 3-step process. First, you balance each account in the ledger, just like we did a second ago. Second, you list all those accounts out with their balances. And third, you tally up the debit and credit columns.
Checking out the Smart Concepts example, this is the grand finale. It's the master list of all assets, liabilities, equity, income, and expenses. And if you look right at the bottom, total debits perfectly match the total credits at 3,285,500 Rand. Let me tell you, when those two numbers match perfectly at the bottom, it is literally the best feeling in accounting. And that brings us right back to our fundamental rule. If your total debits equal your total credits, you've done it. You have proven the double entry system works. It confirms your assets truly equal your owner's equity plus liabilities. The puzzle is complete.
Okay, time to put you in the driver's seat. We've walked through the rules, the lefts, the rights, the whole shebang. Now it's time to apply this to a brand new business scenario. A company called Steph Couture.
So, using everything we just covered in this explainer, do you have what it takes to track their transactions and build a perfectly balanced trial balance? Give it a shot. But, it kind of makes you wonder, if this double entry system is supposedly foolproof, how in the world do massive corporate financial scandals still happen? What exactly is hiding between those perfectly balanced debits and credits? Well, that is a mystery for our next deep dive.